I have a very unique topic today, and I want to talk about the reputational risk that small business owners face whenever they are developing the relationship with their bankers, and the importance of Treasury and how that can affect your reputation, your business, your liquidity, your existing lines of credit and future lines of credit if available. So the Treasury function, as I've mentioned in previous videos, think about it as it's just a fancy corporate word for saying cash management. Anything related to cash management, banking, liquidity, making sure there's enough capital available to cover your daily operations, your upcoming payables, your short-term needs. Anything on the short term within the next 30 to 60 to 90 days is considered liquidity and is part of the big function of the Treasury function, right? Treasury focuses on what is happening today. The Treasury department is to make sure that the blood of the organization, in this case would be the capital, the money, that is constantly flowing within the organization and making sure that every aspect of the organization is receiving the enough liquidity, oxygen that is needed to survive within the organization. Accounting focuses on what happened. FP&A focuses on what will happen. That is a big difference between the accounting department, the finance department, and then the Treasury department. So even though an organization may be profitable, your accountant can tell you, hey, you're very profitable. But profitability does not mean liquidity. It could be profitable, but the profitability does not mean solvency. And in banking and Treasury, solvency is what matters, not profitability. Okay, so I'll give you an example how reputational risk is applicable in your organization, or an organization that is poorly ran with a poor Treasury function or a Treasury department. Let's say that a company is very profitable, but they are not able to have a very good daily operations in the Treasury function where their payables are always met, there's a healthy bank balance, and there's always sufficient capital in the bank account. So you could be very profitable on paper. You make 100,000 in revenue, you pay 50,000 in payables, you're net 50,000 on paper. That's ideal, and that's what it should be reflected on the bank account. But life doesn't work that way, because you have vendors that are requesting expedited payments, or you have clients or customers who don't pay on time. And when you have those two things, that you have late customer payments and expedited vendors, you create this gap. That gap is called liquidity. That gap is where the Treasury function is responsible to making sure that it's always being fulfilled. That is the function of the daily operations of a Treasury department, is to make sure, okay, we have late receivables and we have upcoming payables. How do we meet that?